Again, I'd like to announce your test on Monday will cover chapters 2 and 3. Please, my advice is read the contents of the book carefully because I just copy those statements in your book with regards to the exams I'm giving. So the exam will be again true or false 1 to 20. Okay, so I hope you will read well the fact that I'm getting the questions from there. So Monday is May 10. That will be our last quiz, last exercise. Then on May 17, I will give you your last long exam. That last long exam will include chapters 2 and 3 and then 5 and 6. Now, your final exams will be given on May 26 to 28. And I would like to announce earlier that your final exam will include chapters 1 to 8. Chapters 1 to 8 of the book of Hansen and Mowen. Now, considering that the final exam has the highest weight, actually it's 35%. So I have to cover chapters 1 to 8 of Hansen and Mowen for that exam. Okay? Is there any question before I'll begin? Okay, no more. Now
Ma'am,
let's
excuse
start.
ma'am.
Yes? Okay.
Ang sa exercise, ma'am, sa Monday, 20 items, Japon.
Ang ano, exam,
Ang sa
ang
Monday, ma'am, may exercise, 20 items,
exercise
Japon.
20. Oo, 20, only 20. But we will have two chapters. So I hope you will read well the chapters. Okay, so some more questions. No more. So let's now begin. We have a lot of exercises to discuss this morning. And by the way, on Monday after the test, we are going to begin with chapter 5. We will no longer take up chapter 4 because budgeting was the whole chapter in Vanderbeek chapter 7. So, Monday, we are going to continue with chapter 5. So, next week, we will tackle chapters 5 and 6. And the week after next will be 7 and 8. Anyway, we have already finished chapter 9 with the balance scorecard. Okay, so I hope you will not get tired. Let's cooperate, and our objective is to be an accountancy student. Okay, join the qualifying exam and still join the accountancy group by summer. Okay, I'm hoping this will come true. Okay, so let's now begin with any other questions? Wala na? Okay. I have already told you that some of the items that we will be discussing in chapter 3 we were already taken up in chapter 10 when we were discussing chapter 10 of Vanderbeek, like the make or buy, accept or reject. We have already taken up. So in other words here, it's a mere review or repetition, though we have to consider taking this up again because there are other items that we were not able to discuss in Vanderbeek. So we have now exercise 3-1 or 17-1 is about making a decision whether to make the parts or just buy from an external supplier. Now, the company produces 18,000 units of a component. an outside supplier has offered to buy the part or to supply the part for 1.38, and the unit cost is in the breakdown. The unit cost is with a total of $4. Now, what are the alternatives? Now, the alternatives are to make the part or to buy the part. So, these are the two alternatives. Number two, assume that none of the fixed cost is avoidable. List the relevant cost of internal production and of external purchase. So, the relevant costs of making the part are direct materials, direct labor, and variable overhead. Now, the relevant cost of buying the part is the purchase price. Now, take note that our fixed cost actually is already considered as fixed in total, and this will be applied to the other production during the period and not only to this specific production, so that the fixed overhead here normally is not included in our relevant cost. So the relevant cost of buying the part is 18,000 parts times 1.38. That's the purchase price extended to the buy column. Then making the parts would multiply 18,000 units multiplied by 0.78, 0.34, and 0.13 for direct materials, direct labor, and variable overhead respectively. So if we only make the part, that will give us the relevant cost of 22,500. Buying it would involve 24,840. So the cost difference is 2,340, and that is in favor of making the part. Now, in the case of number 3, which alternative is more cost effective? And that is now the alternative of making the part. Number 4, what if 18,540 of fixed overhead is rental of equipment used only in production of the component that can be avoided if the component is purchased? Which alternative is more cost effective and by how much? So if you have to make the parts in this alternative, in this what if the company will incur an equipment rental of 18,540, so that will be an added cost if you make the parts, and buying it would still involve the same amount. So in other words, it will be more costly if you make the part in requirement 4, and it's 16,200 in favor of buying the part. So in other words, the fixed overhead cost for the equipment, the fixed overhead cost is the one that will reduce, no? Or that will add to the cost of buying the parts. Of making the parts. So what is the more favorable alternative in the case number 4 is merely to buy the parts and in lieu of making. Now we go to question number 3. No, cornerstone exercise 3 does 2, keep or drop decision, alternatives, relevant cost. So we are now given 3 types of rag shampoos, models 1, 2, and 3. While all models have positive contribution margins in the segmented income statement, the company is concerned because operating income is less than 10% of sales. Now, the operating income is only 110,190, and sales is 1,458,600. 10% of it is higher than 110,190. The company's controller gathered additional information on fixed costs to see why they were so high. The following information on activities and drivers was gathered. When we talk about drivers, we are talking about bases. Now, the activities are engineering, setting up, and customer service. If you can recall, if we are dealing with activity-based costing, we allocate our cost based on the different activities involved, which includes these three activities. Then we have the cost and the activity driver or the base, which will be used in allocating the cost. So the activity costs are engineering 30,000, setting up 180, and customer service of 110,000. Now we are going to allocate the cost based on, for engineering hours, setting up cost based on setup hours, and customer service based on service calls. In addition, Model 1 requires the rental of specialized equipment costing 20,000 per year. Requirement 1, reformulate the segmented income statement using the additional information on activities. So, reformulate the segmented income statement. Now, in the case of problem 2, we have 17-2 or um, 3-2 in our book. Now we have the three models, 1, 2, and 3, with the given amounts of sales, variable cost, and then commissions and contribution margin. So we are now given the amounts of here as stated. We are going to reformulate. So still we copy the contribution margin for a total of 798,190, and we deduct the traceable fixed expenses. Actually, the fixed expenses, the fixed common fixed expenses include fixed factory overhead of 398,000 and fixed selling and administrative expense of 290,000, which is actually part of your period cost. So for the engineering cost, we are having 30,000, setting up 180, and we have the equipment rental of 20, and finally the customer service of 110,000. So how do we compute for here? The engineering, the total cost is 30,000. Then we divide it by the number of engineering hours. That's equal to 1,000. 1,000, the sum of 875 and 175. So 30,000 divided by 1,000 is equal to 30 per engineering hour. $30 per engineering hour. So the engineering cost assignments, we multiply 30 times 800 for model 1 times 75 for model 2 and times 125 for model 3. These are the engineering hours. Now, for the setup rate, setting up is 180,000 ang total cost. Then we divide this by the number of setup hours. The number of setup hours is 30,000. So we divide 180,000 by 30,000 setup hours. It will give us $6 per setup hour. And to model 1, we multiply 6 by 12,400, model 2 by 12,500, and model 3 by 5,100. That's how we computed for the allocated amounts. Then for the customer service. And by the way, we are also deducting or including 20,000 for model 1. That's the equipment rental for model 1. So we have now a 20,000. And lastly, for the customer service of 110,000, we divide it by 20,000 service calls, adding the three amounts under each model. So the cost per call for the customer service is $5.50 per call. And you multiply 550 by the respective number of calls for each model. So we now get the total the contribution margin for model 1 is 147,500, and but if we deduct the traceable fixed expenses, we have the total deducted, and finally that will give us the final product margin for model 1 is negative. For model 2, it's reduced, however, it's still 300,840. And for model 3, it's still positive by 203,550, and deducting from the original contribution margin, deducting your traceable fixed expenses of 30,000, 180,000, 20,000, and 110,000, it gives us the product margin equal to 458,190. Okay, then we compute for 458,190. We deduct the factory overhead. The common factory overhead is equal to 398,000, the original amount. Then we deduct 30,000, 180,000, 20,000 from the total of your common fixed factory overhead. So leaving 168,000 because the 110,000 is deducted from your selling and administrative expenses. Originally at 290,000, then we deduct 110,000 allocated to your traceable fixed expenses. So we have the remainder classified as common fixed expense of 180,000. So the operating income of 110,190. It's still the same amount of operating income, only that we have for model 1 after the allocation of the traceable fixed expenses, ang model 1 resulted to a profit or a product loss. Okay, so after the reformulation, that shows that product 1 has a negative result. Using your answer to requirement 1, assume that the company is considering dropping any model with a negative product margin. What are the alternatives? Which alternative is more cost effective and by how much? Assume that any traceable fixed cost can be avoided. So we have now your number 2 answer. The reformulated income statement shows a loss for model 1. Now the alternatives are to keep model 1 or to drop it. Since all the traceable fixed expenses are assumed to be avoidable, in other words, if you are going to drop product 1, the traceable fixed expenses assigned to this model is avoidable. Dropping model 1 will add 45,700 to operating income, making it 110,190 plus 45,700 So it will give 155,840, which is 12.9% of sales. Okay, so that will be higher than the target profit, which is more than 10% of sales. Now, in question number 3, what if free share company can only avoid 175 hours of engineering time and 5,000 hours of setup time, all for Model 1? How does that affect the alternatives presented in requirement 2? And what is the more cost-effective alternative and by how much? If only 175 hours of engineering time can be avoided, the amount traceable to Model 1 is 5,250. That's 30. The rate of 30 is taken by dividing 30,000 by 1,000. So 30 multiplied by 175. And the remaining 18,750 is already part of common fixed expense. Similarly, if only 5,000 setup hours can be avoided by eliminating Model 1, the amount traceable to Model 1 is 30,000. That's $6 per setup time, and we multiply it by 5,000 hours. And the remainder is part of the common fixed overhead. Thus, the product margin for Model 1 is 17,450. That's the original segment contribution margin of 147,500 minus 5,250 minus 30,000 and minus 20,000 and 74,800. So in other words, we have now the difference of 17,450. Now the product margin is no longer negative, and the company will lose 17,450 if Model 1 is dropped. The best strategy in this case would be to focus on reducing other costs and using excess capacity in a productive way. Okay, that's problem number 2, exercise 2. 3 involves special order. Actually, we already have examples of this in chapter 10. List the alternatives being considered. List the relevant benefits and costs for each alternative and which is more cost effective and by how much. Now, the company manufactures box stationery for sale to specialty shops. Currently, the company is operating at 90% of capacity. A chain of drugstores has offered to buy 30,000 boxes of blue bordered thank you notes as long as the box can be customized with the drugstore chain's logo. While the normal selling price is $6 per box, the chain has offered just 3.10 per box. Sikya can accommodate this special order without affecting current sales. Unit cost information for a box of thank you notes. So we have now 4.38. That's now your cost to manufacture. Whereas the chain has offered to buy it only at 3.10 per box, though the regular selling price per box is $6. Fixed overhead is 420,000 per year and will not be affected. Normally, there's a 5% commission on the selling price, but this will not be paid because the drug chain owner is dealing directly with the company. Special order will require additional fixed cost of 14,300 for the design and setup of the machinery to stamp the drugstore chain's logo on its box. Now list the alternatives being considered in problem 3-3. The two alternatives are to accept or reject the order. The relevant benefits and costs are of accepting the order. We have the revenue, direct materials, direct labor, variable overhead, and the cost of designing and setting up the machinery to affix the chain's logo. No fixed cost will be affected, and the sales commission is not relevant. No more sales commission. If the order is rejected, the net benefit is zero. So we have now the two columns, accept or reject, and you have the differential. If you have to accept the special order price is 3.10, then we involve direct materials, direct labor, variable overhead at a total cost of 2.28. Deduct from 3.10, you have the total unit benefit of 0.82, and you multiply it by 30,000 units. So we now get the total contribution margin